Okay, so today I'm going to be doing another edition of the What's on My Watch List series, and we're going to be talking about a company that is probably also on a lot of your guys' radars, and that is Aritzia. So, Aritzia, for those who don't know, is a clothing retailer based out of Canada that is TSX listed, but also has operations in the United States. And basically, 2023 was a very, very poor year for Aritzia. If we take a look at what happened to their stock price over the course of that year, we can see here it was down roughly 50% just over the course of 2023, which remember is a year where the S&P 500 was up around 20%. So they significantly underperformed. And the reason that this happened, to quickly summarize, was one, just due to their product assortment. They just didn't really order products that consumers actually wanted, which then flowed through to their revenue, and their revenue was much lower than expected, specifically in the summer quarters of the year, and also due to a very large and lingering buildup of their inventory balance, which investors took both of those as a sign that maybe the company was starting to have some execution issues, and that is possible that it could persist for a while. But it's also possible that investors just saw them as another victim of just a general slowdown in retail spending because they are considered an everyday luxury type of brand, and consumers are still coping with the effects of rising inflation, which for a lot of people has probably outpaced their income growth, and it's causing people to cut back on spending in a lot of areas. But then what happened for Q3 2024, which is results they released just last week, was it was much better than expected. Gross margins were back in line with what investors expect them to be, and comparable sales actually increased very slightly, 0.5%, where the consensus was that those were going to go down. So as a result of that, their stock price went up very significantly over the course of just a few days. We can see here up 27% over the course of literally just about a week or two. So when you see something like this, you may think, okay, well, why are you making a video about Aritzia now? Isn't it kind of too late? I mean, you're showing their stock prices up, almost 30% just over the course of a few days. Haven't we kind of missed the boat on this one? And I want to make the case that we haven't. And actually, if you look at what Aritzia has set their targets out to be for the future years, if they're able to achieve those targets, then they're actually quite undervalued right now. So I want to show you some of the work I've done in understanding and analyzing this company, and just give you my thoughts on it, and just talk about a bit of background on Aritzia, some of the unique aspects of their business, and then go more in depth on these issues that they've had recently, and then conclude the video by actually doing a valuation to see what makes sense to pay for this company. So without further ado, let's just dive right in. So, like I said, Aritzia is a clothing retailer that operates in the US and also Canada. Currently, their revenue is roughly a 50-50 split between the US and Canada. And they IPO'd back in 2016. And over the years, they have very successfully grown both their e commerce business and also their store count to increase their revenue pretty substantially. If we take a look at what their annual revenue has done over the past few years, we can see this is in US dollars, by the way, about 500 million in 2016, and grew it to about 1.6 billion in 2023. So pretty strong growth there. Now, because this is retail, specifically fashion retail, it is highly, highly susceptible to changing customer tastes, which are notorious for being very fickle and very difficult to predict. Now, there are certain companies out there that can command very strong brand loyalty as they grow and scale up their businesses. For example, Yeti is one that comes to mind, although Lululemon would probably be a more direct comparison to Aritzia. Some businesses just have that unique aspect about that, and they're basically immune to the fast changing nature of fashion and just consumer tastes overall. But personally, I don't believe Aritzia is one of those companies, which means we can't really value them as aggressively as we would with Lululemon. And I think 2023 kind of proved that, just due to the issues they had with their product assortment and the lower demand, lower revenue that they had as a result of that. And we just have to accept with this company that a big part of their success depends on their ability to stay on top of changing customer tastes and identifying the latest fashion trends, which is something that they have historically been quite good at, pretty much up until just a few quarters ago. So the simplest way to describe this potential investment in Aritzia, we can call it, is it's basically a bet on a return to normal, which if they can return to normal, they can get back to the point where they're worth, mid 50s per share or even potentially higher than that. But that's not going to happen unless this company can prove to investors that they are back to being the growth story that they once were, which is by no means a guarantee. And by the way, if you're wondering what this website is that I'm using here, it's a website called tickernomics.com. This is a website that I personally created that has data on US stocks, Canadian stocks, and international stocks, financial statements, and a bunch of other features as well. So if you are interested in using it, it is currently free. I'll leave a link in the description and you can check that out. So let's talk about 2023 now. So basically what happened was consumers didn't like their product assortment this past summer, so demand was just lower overall as a result of that. And it was that combined with inventory that's been high for a few quarters now, which means their margins were under a lot of pressure. Now, because Aritzia does have centrally managed inventory with 3 distribution centers, they have 2 in Canada and 1 in the United States, carrying too much inventory means operating costs go up because you need to pay more employees to manage it. You have to lease more space to store it. And margins are already quite low in retail. So if inventory builds up and you're not managing it well, then you're going to see that go through to their gross margin and their operating margin as well. So just to show you what this actually looks like, we can start with looking at what their inventory balance has been like because, like I said, this is a key driver of their success. And what we're going to see is for Aritzia is it increased very significantly pretty much going into the mid part of 2022 here. And it's kind of stayed at this very high and elevated level. Now, we're not going to expect it to go back down to here because sales are much higher, but we don't expect it to be, basically 4 times as big as what we're seeing here. So this is something that's key. And then something else is the operating margin. So we'll take a look at what the operating margin has been just going back a few quarters. And we're going to see that it decreased very substantially, kind of in this range, where historically it was kind of in the 12%. We call it between 10 and 14%. But then in these quarters, it went down to about 2%. So it went down a lot. They didn't make as much money, which obviously is going to flow through to the stock price. But the company doesn't really have a history of doing this. This was really just a one-time scenario where these two things led to really, really bad few quarters. And management does actually have a history of pretty much always doing what they said they were going to do, except for the past few quarters. So that was one issue. And then investors do what investors always do, which is take very recent news and project it out way into the future without giving any regard for the fact that maybe this is just a one-time thing and it's possible that things are going to self-correct in the future years. Now, like I said before, there were some secondary concerns over inflation and basically inflation hollowing out the middle class, which is a big part of Aritzia's customer base as an everyday luxury type of retailer, which could mean lower spending for, several years into the future. And of course, all of this ended up getting baked into the stock price, which is why we saw such poor performance going into this year, and it went down a lot. But just a few days ago, they released their Q3 results, and things were much better. Revenue was higher, same-store sales growth increased when it was expected to decline, and this started to signal to investors that it's increasingly likely that Aritzia can return to normal, which up until this earnings release, there was pretty much no evidence of that. So that's why you see such a big correction. It's kind of why investing in them now, although we have to invest in them at a much higher price point than, say, 2 weeks ago, we get the luxury of all this information that was included in the Q3 report, which tells us, there's less of a cause of concern for Aritzia. Now, that being said, I don't think it's reasonable to expect them to go back to the mid 50s per share range, at least not in the next year. Because remember, when they were at that range, that was in 2021. In 2021 and the beginning of 2022 was a very, very different time, right? Inflation wasn't really a concern then. Interest rates were basically at zero, which, I mean, all else equal, if you just lower interest rates, that's going to raise the value of equities overall. So we can't really compare them to that point, and the business has to be fundamentally much better than, comparing them back to that point. It has to get fundamentally much better in the future to get to a point where they're back in the mid 50s per share. But personally, I think if they can achieve their targets, then they can do that very easily, which as we talk about next, the growth drivers, you're going to see why that's the case. Okay, so now let's talk about their growth drivers. So, what is actually going to drive this business forward the next 3 years, the next 5 years, and even beyond that? I'm really trying to take a long term view of this company and not just focus on quarter to quarter fluctuations, even though those can be revealing and tell you interesting things about the business that you need to know. it's always important to keep that in the context of a longer term view. Try and see where do you think this business is going to be 5 years into the future. So the number one most important growth driver for Aritzia is their ongoing expansion into the United States. So currently their revenue is about a 50-50 split. I think it's a little bit more in favor of the United States. But it's not just about them opening new stores in the US. Obviously, that is a big part of it, but it's also about how the US is very, very different from the Canadian market. So these points that I'm going to cover, I actually stole these from a Value Investors Club article. So this isn't all my own proprietary research, but I think these are very good and valid points that are worth bringing up. So number one is there's just a general lack of brand awareness in the US, which is evidenced by an 80% uplift in local e commerce sales after a new location has been opened. So, say they open a new location in Minneapolis, for example, what they're noticing is more e commerce sales coming from that specific area. Which, they could have ordered from Aritzia before, but maybe they didn't know about it until one opened up near them. And this is also backed up by the fact that if you look at Google Trends data, which is something I talked about in a previous video, actually, that Google Trends is a very useful resource if you're trying to do, very in-depth due diligence on companies, because it shows you what people are Google searching, which if you can see trends in what people are Google searching, in some way that's going to flow through to the demand effects on actual companies, some of which are publicly traded companies. So Google Trends data shows a 2 to 3 times increase in search volume in the corresponding area of a new store opening, right? So to me, that's very interesting. And then also, US stores just tend to be larger, 7.5 to about 8,000 square feet versus in Canada, which is 6,000 to 6,500. And sales per square foot are higher in the US due to higher price points and targeting more affluent customers. And they basically publicly stated that their goal is pretty much just to expand in the US. They actually haven't opened a new store in Canada for, I think, a few years now. And they're looking to add about 8 to 10 new US stores annually up until the year 2027. Right. So those are all very important insights, right? And that does kind of spell a very bullish narrative for Aritzia. Now, of course, we have to keep this in the context of what's going on with the economy as well, and the fact that this is all very uncertain, right? It's not a guarantee that it's going to be a successful expansion to the US. It's a much more competitive market. But these are all very promising points here. And then another one is their continued growth in e-commerce. So currently e-commerce revenue is about a third of their total revenue, and the industry average for, companies that offer similar products, kind of everyday luxury, is about 45%. So it indicates it's a little untapped there, that they can maybe invest more in their e-commerce, which historically under their old CEO, they weren't really doing that, but they changed CEOs in 2022. And, it's speculating that this is going to become an increase focus for them, which they do have this whole campaign that they've called e-commerce 2.0. Of course, it remains to be seen how that's going to turn out. But this is another growth driver for them. And they do break out these metrics when we actually look at their results that they release each quarter. We can see they break down retail revenue, e-commerce revenue, and then also United States revenue. So these are things that I am going to be tracking over time, and I have been tracking over time here to try and see how these trends play out, because these are very important drivers for them. Okay, so now before we dive into the valuation, which is the last part of this video, I want to take a quick look at the balance sheet, because this is going to tell us what sort of real estate strategy does Aritzia use, because pretty much every retail stock out there takes a different approach to how they manage their locations. Do they own some locations? Do they lease some? Do they have locations of different sizes and different, geographies and that kind of thing? And what they do is it's actually very simple. They pretty much just lease all of their locations, and they actually have extremely little debt. I mean, they have about 250 million in accounts payable, which for a company that's constantly purchasing things and selling them, you'd expect that. A little bit of deferred revenue here, but other than that, it's pretty much just lease liabilities. And their lease liabilities are pretty significant, about 800 million worth, which just relates to basically the future payments they have to make on their locations. And it does come with an offsetting liability, which you call a right of use asset. So the right of use asset and the lease liabilities, you can kind of think of them like two offsetting accounts, an asset side and then a liability side. Now, with these stores, right, obviously where the stores are located is a pretty big deal. They have to be in prime locations in big cities, and they still need to be economical, right? These are very expensive locations. So the initial investment, you want it to be paid back ideally within 2 to 3 years. Now, they do actually give us some information on this, which we can look at the section here called store economics, and then this is basically the payback period for their stores, which they say is about 12 to 18 months, which consists of $3 million initial investment. So this isn't really, any sort of purchase of property because they're leasing it. It's really, decking out the property, right? Like having all the lighting, having the cafe, which they have those in some stores now, all the furniture, all the decorations and that kind of thing. So it's about 3 million per store. And then you look at the actual sales that it can generate over a period of about 12 to 18 months, and then the profit that you get from that, it's paying back itself within 12 to 18 months. So that's pretty good store economics overall, and it's pretty good capital allocation, which is really something you need for a retail stock like this to be successful. Okay, so now let's dive into the valuation. Now, to value this company, I'm going to use the value a stock feature on my website, Tickernomics, which this basically does all the math behind doing a discounted cash flow valuation for pretty much any company that we want to enter into it here. And it's going to load some data for us. Now, for a profitable retail stock like Aritzia, the discounted cash flow method is definitely the best valuation method to use because they are profitable, they are cash flow generative, so we can basically value them how you would value any investment, which is present value of future cash flows. So I'm going to do a 4-year analysis for Aritzia because a lot of their goals that they have stated, what the targets they want to achieve for their business are by the year 2027. So that's 4 years into the future. So I'm going to align with that. And then we basically have to change all these assumptions that we have in here. So revenue growth, operating margin, etc. Now this tax rate, this seems a bit high. So this can fluctuate a lot depending on the data that it's picking up. Usually around 25% is a reasonable tax rate to use. The capital expenditures and depreciation amortization, all the numbers that get populated in here, by the way, are just 5-year averages. So I'm just updating these to be basically more in line with what we've seen from Aritzia in more recent years. And the working capital investments, I'm going to increase this to 50 million per year. This I'll change to 0, and then I'll leave the cash balance and debt balance the same. Now, another very important input we have to have into this model is basically the terminal value multiple. This combined with the revenue growth and the operating margin, so these two at the top, are the 3 most important inputs for pretty much any DCF that you do, but specifically for retail stocks, because how much revenue growth you're expecting them to get, what operating margin they can earn on that, and then at the end, what they're approximately selling for on a multiple basis is really going to influence most of your investing results. Now, for picking a multiple, so I'll go back to here and I'll go to the charts, and I'm just going to look at, because this is the enterprise value to EBITDA multiple, I'm just going to look at what this has been historically. Now, you can see it goes up and down quite a lot because their EBITDA fluctuates a lot throughout the year. For example, their Q4 and Q3, they earn a lot more, revenue, earnings, EBITDA than they do in Q1 and Q2. So naturally, you're going to see this fluctuate a lot. But pretty much in this period here, we can see it's kind of averaged in the range of, we call it between 12 and 15 multiple. Right, so I'll go on the more conservative range of that, and I'll just change this to 12. Now, the first thing I want to try and do with this valuation is I want to try and determine what investors are currently pricing into Aritzia stock. What revenue growth, what operating margin are investors currently expecting them to achieve over the next 4 years? So I'm going to decrease this to about 5% just to see, what this ends up putting our valuation at. So now we've changed all our assumptions here. We have them what we want them to be. We'll click calculate DCF. And here, again, this is in US dollars, but we have an intrinsic value per share of 27 versus a current price of about 25.5. So roughly in line, right? So from this, we can understand, okay, investors collectively are expecting Aritzia over the next 4 years to achieve 5% revenue growth on a 12% operating margin. Now, is that reasonable? Well, for one, let's compare this to the goals that they have publicly stated they're trying to achieve. So they want to achieve by the year 2027, we can see it right here, 3.5 to 3.8 billion in Canadian dollars of revenue, and they want to grow their EBITDA margin, as we can see here, to about 19% by fiscal 2027. So an EBITDA margin, I worked it out, of about 19% is roughly a 13% operating margin. When you account for depreciation and amortization, which historically was about 6% of their revenue. Now, revenue growth, they did kind of say here, it implies 15 to 17%. So let's go in the mid range. Let's go 16% annualized revenue growth. This is when you start to believe maybe Aritzia is undervalued, because we get an intrinsic value per share based on that of about $41 versus a current price of about 25. So when you see that, that's pretty strong evidence. And like I said, Aritzia management does have a history of actually achieving their goals. If you go back to basically what they were saying they were going to do when they IPO'd in terms of, their future targets of pretty much any financial metric, they achieved it, right? So management does have a good track record, but that doesn't mean it's guaranteed, right? They could run into more issues with their product assortment. The expansion to the US could not go quite as good as planned. But I did do just some general reasonability analysis of those numbers, right? Because the way that they're going to actually achieve that revenue growth is they're going to open, in the US specifically, between 8 to 10 new stores per year. And they said they already identified 100 locations that they could expand to. And they're going to pick up their e-commerce growth, right? So another important thing you have to understand, and this is really a key driver for, their future results, is US stores are significantly more profitable. They generate a lot more sales than Canadian stores. Like I said before, they're bigger. The brand isn't as well known, so there's an uptick in e-commerce sales. So basically, if we try and project their revenue, which is what I've done here, where we say, okay, going by each year, how many stores in Canada will they have? Which I basically said it'll stay at the current amount, which is 68. It's not going to change. They open 8 new stores, so kind of the lower end of the range of their goal of 8 to 10 per year. And then you look at, on average, how much revenue are they earning in per store in Canada, how much per store in the US. We assume about 5% annual comparable sales. They can get to that 3.8 billion by, I have a 2028 here, right? So call it 3.4 billion by the year 2027. So personally, I think it's reasonable, right? And I think this kinds of backs it up, but there is still a little bit of risk inherent in there. It's not a guarantee. And that really summarizes, I think that's a good way to end this video, because that really summarizes the key of this investment, is it really just depends on their expansion into the US. So if you are interested in this company, what I'd suggest is make sure you keep up to date with these metrics that they disclose here on a quarterly basis, the e-commerce revenue, how that expansion into the US is going, because certainly if they can achieve the goals that they're setting out to, there's plenty of room for upside. So I'll end it there. Thank you so much for listening, and I hope you did get some value in this video. If you did, please leave a like, and if you're new to my channel, I would appreciate it if you would consider subscribing, and I'll see you guys in the next video.